The Reserve Bank has revised up its economic forecast for core inflation and wages growth, but also warned further interest rate rises will be needed this year. Joining me now is business reporter Edward Boyd. So Ed, this statement of monetary policy was released a short time ago. The bank is now expecting inflation to stay higher for longer. Talk us through the revised figures.
Not good news for the Australian economy here, Tom. The Reserve Bank statement of monetary policy today has released some new economic forecasts, and they previously had headline inflation at 6.3% in the June quarter. They've now increased that to 6.7%. So that basically means with inflation in the December last year at 7.8%, they're only expecting inflation to fall by roughly 1.1% over a 6-month period. So inflation is going to be sticking around longer than expected in Australia's economy. But the other part to this as well is they've increased their wages growth expectations. So they were expecting wages growth to be at 3.7% in the June quarter this year. They've now increased that to about 4.1%. So wages are increasing and inflation is not coming down as fast as expected. So the Reserve Bank today briefly mentioned the word wage price spiral, where wages go up and inflation goes up, and together they contribute to more and more inflation in Australia's economy. So they're trying to avoid that. How do they do that? Well, the solution so far has been aggressively lifting interest rates in the economy.
It has been. I mean, worth noting, you're still seeing wages going about half of inflation. So not there yet, but these are all part of the forecast. Look, the interesting thing here, the RBA says 1/3 of all home loans are on fixed rates, but over the next year, half of those will reach the end of their term. So what we're talking about, 1/6 of all mortgage holders at the moment have fixed loans, which we assume are on those very low rates, or at least the vast majority on those very low rates that might be sort of 2 to 3%, and they'll be coming out and facing 5 or 6%. This is the size, the true size, if you like, of the so-called mortgage cliff.
This absolutely is, Tom. And in fact, the RBA have put out a couple of charts today really explaining it in their statement of monetary policy. We can put up the fixed rates chart on the screen for you here. You can see on the left interest rate levels, outstanding loans, that interest rate is coming down, and the new loans in the orange line is jumping significantly. So you can see there's clearly a big difference with new loans that are being written. They're much more around the 5.5% to 6% level. The old loans, interest rates were much, much lower throughout 2020 and 2021. If we go to the next chart, we can actually look at variable lending rates in Australia. And this is going back to 2007, but you can see that massive increase there at the very end of the chart around 2023. You can see variable rates are tracking much, much higher. So, the Reserve Bank today says about 1/3 of all housing loans across the country are fixed rates. Half of them over the next 12 months will be repriced. So, they're going from 2% to 6%. This is that mortgage cliff we've been talking about where, a 4% increase on a home loan, that's thousands of extra dollars per month in repayments for a lot of households. And that's really they're going to be feeling the pinch very soon, Tom.
Exactly. 2, 3, 4%, whatever it ends up being. As you say, thousands of dollars, depending on the size of the loan. What we don't quite know, of course, is how many of them have the buffer. We know savings are out there, but they're not equal. Wealthy households have a bigger buffer. So who is really facing the pinch there? Well, that's the unknown question that nobody quite knows the answer to. Now, next week, Governor Phil Lowe has his first public event of the year. He'll appear before the Senate Economics Committee in Canberra. This will be, look, I know for you it's always appointment viewing, Ed, but this will be appointment viewing for everyone. All the talk of Phil Lowe's future, but, the questions people want answered around how many rate rises are we really going to have, how much pain, and to what extent might we see, mortgage foreclosures, which don't often happen in a big way in this country because of our bankruptcy laws.
Yeah, I've looked through the last couple of years of Phil Lowe's public appearances, and he's kicked off the last 4 years in a row with a speech at the National Press Club in the first week of February. That's not happening this year. For some reason, he's not going to be speaking there. Well, he's not listed to speak at least. So his first public appearance is before the Senate Economics Committee on Wednesday, and then the House of Representatives Committee on Friday. So he's going to have 2 appearances next week. Expect lots of questions to the Governor from both senators and the MPs just around how high interest rates are going, the bank's guidance for 2024. That was a big topic last year where Governor Lowe apologised the previous time he appeared, he actually apologised to the people saying, look, I'm sorry, I was misinterpreted. So he's obviously under a lot of pressure at the moment. The other thing as well, Treasurer Jim Chalmers' review externally done review into the Reserve Bank. That will be coming up in March, so we'll get that as well. So there's a whole host of factors here that are putting pressure on Governor Lowe and the Reserve Bank. And the most important one, obviously, is how high interest rates go, and the pressure that is now on a lot of households. Because the RBA, in their statement on Tuesday, said a lot of households are now feeling the squeeze, and it's obviously going to get worse over the next few months as rates rise. Because they're 3.35% today. Market's now pricing in potentially 4.1% for interest rates, so substantially higher.
I think everyone wants to know as well to what extent the RBA thinks a soft landing, or in other words, avoiding a recession, is likely.